This week on The Art of SBA Lending.
I have not seen a case where an MCA actually successfully brought the company or the borrower to where they needed to be.
There is a lot of bad actors in our space because everybody that came from Wall Street, mortgages, who, after they got beat up at the mortgage drop, they all jumped into this space because they saw there was real money to be made.
Everyone has gotten in the game for unsecured financing because it's quick, it's accessible, it's fast, and it's convenient.
See, I'm like you, John. I like to yell at people to get off my lawn as well. I can't stand some of these younger BDOs coming into the SBA space, and they're barely out of college. They're shaking things up, and they've got a sharp tongue, and they're giving guys like us a bad name because they're structuring deals incorrectly.
I remember I had a boss one time who used to say, if you bring me a problem, you better bring me a solution. Well, the problem is that taking titled vehicles as collateral can be very cumbersome. And the solution is CorpSmart. When you have a loan involving titled vehicles, CorpSmart is there to handle everything, from transferring the registration to taking title to making sure that the sales tax is paid. And I've got to be honest, I didn't even realize sales tax was a thing until just a few years ago when my borrower called me from the closing table because he got hit with a $50,000 bill at closing that I didn't account for in my structure. And so in the spirit of solutions, CorpSmart has an offer just for Art of SBA listeners. Now you can quickly and easily request a DMV quote directly from the CorpSmart website so that you can accurately account for all of your closing costs up front and properly structure your loans. Just go to corp-smart.com/art of SBA. We'll leave a link down below. Thank you for tuning into the Art of SBA Lending. We have an interesting one today. About a week or so ago, an interesting debate sparked in one of the posts on our LinkedIn having to do with MCAs. Is it a loan? Are they bad for business? Do they serve a place in the market? We're going to break it all down today because we've got a panel that's going to debate this topic back and forth. Some of the folks that were in that debate, within the LinkedIn comments. So I'm going to introduce them, bring them in, and then we'll have some opening remarks. So sit back, grab your popcorn, and enjoy. Ryan Kroge from First Internet Bank, Joseph Allam, Midstates Advisors, John Dicanio, My Biz, and Jerry Cocuzzo from FundAll Capital. John, why don't I throw it to you first, and you can just kind of break it down with some opening remarks on kind of where you sit on this issue.
Sure. So just a little bit of background. I've been in the alternative finance space, which is MCAs, for about 17 years now. And I've heard this debate probably for the last, 10 or 12 years about, how merchant cash advances are predatory. They're no good for clients. So over the past 10 years, I've been working with clients that try to do both sides of the fence. And I'm here to just talk about what some of the benefits are, how it actually helps some of the clients compared to, going into an SBA and, trying to get all the documentation that they might need, where it takes 30, 45 days to get a deal done, compared to our side of the fence. Yes, it's quicker, less documentation. They don't do a lot of background stuff. It's literally 4 months of bank statements and an application, and we're basically underwriting your file based on how healthy your bank statements are, meaning that there's not a lot of overdrafts, insufficient funds, things of that nature to get you approved, to get you funded literally in less than 2 hours.
Well, thank you for that. Ryan Kroge, I'm gonna toss it over to you, kind of give us your stance on this issue.
Sure. Well, merchant cash advances are simply that. They're advances based on your merchant services and revenues that you're generating through a bank account, which is why, as John alluded earlier, they only need 4 months worth of bank statements. That's to get a hold and understand your cash cycle. Once they understand your cash cycle, that's their underwriting. That's what they are going to advance you based on your bank statements. How much cash are you going to be able to generate after your expenses to be able to pay them back within your cash cycle, which is generally between 1, 3, or sometimes 6 months. So you could get a really good payday advance loan. Merchant cash advances aren't bad as a product itself. Where the bad stuff comes in is when they're abused, when they're abused by either brokers or by business owners by simply not understanding the product. And that comes when they are forced to stack them one on top of each other, which is what I see. So I specialize in SBA lending, and I get a lot of brokers bringing me debt saying, hey, we've got 3, 4, 5 MCAs out there. We need you to consolidate them into an SBA loan. But by the time you have these stacked, it's already too late. The cash flow has already been significantly drained out of the company. The guarantor's credit score is already shot, and they're already in a bad situation. Because what we're seeing on our side when we get this is they're not just getting that one MCA loan, right? Or I shouldn't call it a loan because it's not a loan. They're not just getting that one cash advance, right? That one cash advance is to hope one cash cycle. You start stacking them like a lot of these brokers too, because let's face it, they get paid 10 points on each MCA that they put out there. So there's a big carrot out there. And hang on to that word. We'll get to carroting next. They'll stack them up with any individual borrower more and more and more based on those same bank statements. Well, now your one cash cycle gets doubled and tripled and sometimes quadrupled. They can't make those payments. Now all the cash is being drained out of that business. And sometimes the borrower's doing it on their own volition, thinking they can catch up. Sometimes it's the brokers talking them in. This is a better way to get money quick, get money fast. And then by the time it lands in my lap, it's already a disaster. So while I don't think the MCA, merchant cash advances, are a bad product, I think they have their place and I think they're useful in society and for business owners. I think the abuse, the rampant abuse that I've been seeing over the last 5 years is becoming, giving it a negative stigma in the market, and it's also a significant detriment to small business owners on Main Street.
Let's open it up there, and I'll go to Jerry. But you guys can kind of jump in a little bit here and there as just to kind of as this debate sort of opens up. But what's your response to that, Jerry?
Okay, I think both have valid points. The issue is, Mr. Kroge, you're right in regards to cash flow does get drained. Typically, most healthy businesses can manage 1, 2, in some cases 3 MCA loans. The problem that happens, which is what you're, I guess, saying, is when they get to that 4th and 5th, what happens is the terms get shorter, and that puts a chokehold on the cash flow, and that is when the business does get hurt. Most healthy businesses can sustain 1, 2, or 3. Once you get to that 4th or 5th, the terms get so short that, yes, you are right. However, if you do strictly SBA loans, the problem is you can't really touch a file for 3 years. Right? Because that business needs to be in business 3 years, needs to have 2 years business tax returns. And guess what? You better show some type of profit, which a lot of business owners at the end of the year don't want to show a big profit for tax reasons. So there is a good place for MCA, but I agree with you, Mr. Kroge, that yes, there are bad actors out there and they will go out there and double and triple stack those deals. And just to your point though, if someone does do that, a broker does double or triple stack a merchant, that's a very frowned upon thing in this industry, and good lenders won't fund that guy down the road. So,
and I'm glad to hear that, Jerry, because it's a bad trend, and maybe it's because I'm the takeout lender, right? I'm the SBA guy that's seeing this after this is an absolute jumbled mess. Right? I've done some research on MCA because while it's been around forever, right? I mean, heck, you can go into the larger receivables with factoring and things like that I'm more accustomed to. They've been around forever, but only within the last 5 years has it really accelerated. You've started getting a lot of these marketing giants out there really pushing it. You hear it on satellite radio all the time, these merchant cash advances. They're everywhere. Quick closing is exactly it, Jerry. That's the enticement to get a lot of these businesses. I just want to correct you on just 2 things. I think you're coming from a very great spot. I love how you're starting off on this, but we don't need 3 years or even 2 years of tax returns to do SBA loans. I do them sometimes with no tax returns, with less than 6 months in the operation. It's just a longer process. So granted, a MCA loan you could probably get done in 2 to 3 weeks, whereas it probably take about 60 days for us to get something done. So there is a difference of a timetable there.
But in 6 months in business, though, aren't you capped out at dollar amounts? Of course, it's 6 months in business, and you still have to have a 680 credit score. No,
not according to SBA. That's not SBA SOP. That's just not. You know, I've got 26 years experience doing nothing but SBA lending, and I started as an SBA underwriter when they actually just shove the SOP down your throat until you choke on it, right? That's not SBA SOP. You can be in business for 6 months, go for an expansion, go for debt consolidation, as long as it's prudent lending by the lender, as long as the bank agrees to do it, the SBA is going to back it up.
Can I go to Joe real quick and just get his take on this whole thing, just to get him in here?
Yeah. So look, I have a very different opinion of MCA loans. I've never seen them successfully work for a client unless that client most definitely 100% had a backup funding source to take out the MCA. And I shouldn't call it a loan, it's a cash advance. Unless somebody is there with very reasonable rates behind them, MCA loans have not worked in any case that I've ever seen. In fact, going back to what you guys were talking about, stacking them and how that's, it's bad actors doing that. Most of the time when I see these MCA loans in place, cash flow has been choked to a point where they're forced to take out the second. They're forced to take out the third. Look, if I'd ever seen one really successfully work for somebody, I wouldn't have such a strong opinion about it. From what I've seen, and good job for the lobbyists and the attorneys and everybody, but from what I've seen, it's a way to skirt the usurious lending laws. And by the way, there are bad actors out there. They're quoting interest rates to people like it is a loan. And they're quoting them like, oh, I'm getting you a 13% loan. Even if that was supposed to, they shouldn't be doing that, right? Because it's not a loan, right? But by the way, they're quoting the wrong interest rate because that's as Ryan said earlier, it's over a 3-month period. You annualize that, you're talking about 50% plus interest. So it's just the industry I just have not seen work successfully for somebody that doesn't have 90% margins.
You're talking about programs at 3 months. We have programs that go out 24 months, and you're talking about we have programs that go as low as 16 and 17% which is a factor, at the end of the day, right? But I don't know how many use cases you've seen of cash advances not working. Like I said, over 17 years. Don't get me wrong, I still do SBAs. I still try to if a guy has bad credit and he needs to take care of something for cash flow, it is part of my job to make sure that I am going to try to get him a different type of product after the fact, because yes, down the road there is a lot of bad actors in our space, because everybody that came from Wall Street mortgages who, after they got beat up at the mortgage drop, they all jumped into this space because they saw there was real money to be made. So yes, so there's a lot of bad actors. There's a lot of guys that don't know how to explain what a cash advance is. So what they do use is they use what you just said, that 13%. So that 13% is actually a withhold number, right? So, and people that don't know, because they're not educated inside the contract, when they say, here's a 13% deal, they look at that contract and it says it's a 13% withhold. That's not the actual cost of capital. And there's a lot of guys that do sell it that way, because when they sell the withhold at 13%, it sounds good. But if they tell them, the true cost of capital over whether it's 6 months, 8 months, 10 months, and 24 months, and let's just say my factor is 24, they are paying 24%. And I'm giving it to them on either a weekly or bi-weekly, and they do have dailies. I know you guys have been saying, off the credit card shares. That hasn't been done now probably in the last 7 years.
Nobody does credit card splits anymore.
Right.
I never see that. It's all bank accounts.
Yeah, it's all bank accounts is what I see as well.
Yeah, I would like to get it back to the credit cards, because really I think it's a better product, because now it fluctuates up and down with the volatility of their business. So if they do actually a lot more in credit cards, that percentage remains the same no matter how much revenue they do. So if it drops down and the business gets slow, even though my percentage is the same, I actually drop down with their revenue, so I'm not taking too much of their revenue off the top.
And look, it goes back to straight up abuse. There's bad actors in every industry. I'll take mine for example. SBA has exploded over the last 5 to 10 years. It's become more popular with banks, more popular with non-bank institutions. Everybody and their mother's trying to jump into SBA. And so as a result, you get a lot of bad actors. You get a lot of people trying to sell the bad thing up front, trying to convince them to get into something that's not suitable. I love to use the word suitable because in my world, that's a big thing. If you're trying to push somebody into something that's not suitable, that's against regulatory standards, right? But where I think we get a lot of the safe space on my side, where we get a lot of the risk management and the pushback, is because we have to go through an underwriting process on a whole entire paper stack. We have to look at the personal guarantor. We have to look at the business, 2 to 3 years tax returns. We have to take a deep dive into it. Where I think a lot of this gets messy with some of the bad actors in the MCA space is that there's no full underwriting, right? Because you just look at 4 months of bank statements, you find that gap, right? That cash cycle where the profit meets expenses, and you're able to lend that out, whether it's 3 months to 24 months, right, John?
Yes.
And you're doing the ACH automatically. What I see normally is on a daily basis. Sometimes it's on a weekly basis to take that money out and make it back. Now, when they're coming to you guys, right, you generally don't get the A grade paper, right? They've already got.
If you've been a fan of the show for a while, then you know one of my favorite companies to work with is Rapid Business Plans. Last year alone, their business plans helped facilitate over $600 million in government guaranteed lending. They're on track to beat that this year. More and more small business lenders and their borrowers are relying on Rapid to help with the business plan, projections, and assumptions because their team goes the extra mile to ensure everything is done fast and done right. And that helps streamline the process. They're great at export business plans, by the way, which are critically important at protecting that 90% guarantee. Rapid also offers feasibility studies, which tells you if the project is, well, feasible. I would recommend these for any large startup loan because it protects you and it protects the borrower and helps you get more good deals done. Go to rapidbusinessplans.com to set up your Get Acquainted call today. Find out why so many top producing BDOs recommend Rapid to their small business borrowers. We're going to leave a link in the show notes just for our Art of SBA listeners. Now let's get back to the show.
They've already got bad credit. They've already got issues. They're already falling behind on other vendors because they've already gone to guys like me, and we've declined them because of the situation that they're in. Now they know when they go to you, all they have to show is bank.
But it's not always like. I think
you're right. It's not always like that.
Well, I think that's a misconception.
Sorry, guys.
Right?
Let me jump in.
I'm just
quick.
showing what my experiences is, the type of individuals that I'm seeing.
That was actually my next question, and I wanted to get Jerry in here on this actually, and we can go to John after. But Jerry, why are people coming and turning to this type of financing?
That's a great question. But just to touch your point, Joe, and that's what I was saying a little bit earlier. You're talking about 60-day deals. You're right. Like a 60-day deal is going to crush somebody. So we don't typically do those, and that wouldn't be a first, second, or third position. That would be like a fourth or fifth position loan, like I spoke about earlier. Not here to promote any funding shops or anything like that, but there are some lenders out there right now in the MCA term loan space that are doing 2 or 3 year deals. There's really, honestly, when you spread it out, if you give a guy $100,000 over 6 or 12 months, yeah, it might hurt him. You give it to him over 2 or 3 years, it's a little bit different situation. And we're getting deals right now, John, you probably noticed too, 16 to 18% on an annual basis, where I got a line of credit with Chase and it's 15% with Chase. Okay, so the rates right now, SBA is what, 11? Right?
10 and a quarter is max price.
Yeah, right. Okay, but let's be honest with you guys.
10 and a half if you go to Ray Shop.
Yeah, but let's be honest. It's not a good number, right? Right?
That's a great number.
No, it's not. It's a terrible number. Come on,
but
man.
over a 10-year span, I mean, you're compounding that interest. So in actuality, you're paying more over that long span of time. Yes, I get it. The ease of the payment is a lot lower.
Here's what I think where the
it's all about suitability. In my books.
You're not wrong about that, but here's where I think the MCA does come in place, okay? And there is a place for it. For example, we deal with guys that do $5-10 million a month in revenue, okay? It's not just, the local butcher down the street. If a construction guy is my prime example, a heavy construction guy who has a $10 million project, okay? He's going to get $10 million in revenue over the next 12 months. He's going to make $3 million on this project. How is he going to fund the payroll? Is he going to go to the SBA and wait 90 days to get declined? Because he's got to come up with $200-300K a month in payroll for the next 3, 4, 5 months. He comes to guys like us. And to be honest, my shop, we're 50-50. We do 50 MCA, 50% SBA, and lines of credit and term loans. We do all that stuff as well. So I understand both sides. Like John, We do both sides. But there is the place where a guy says, hey, I need $500,000 by next Friday for payroll, or the parking lot's going to be empty. You guys can't facilitate that.
I mean, a line of credit should be appropriately handling your monthly cash flow needs. I mean, that's
Correct,
the point
but most
of like,
lines of
you
credit
if you're.
Most lines of credit aren't going to give a guy $1 million in an unsecured loan. They're not going to do that.
Right. And also depending on who you're going to and what bank that you work in, right? Usually if it's a Chase Bank or a Bank of America on a line of credit, they're giving you 10% of what your gross deposits are. So if you're only depositing $3 million a year, you're only going to get $300,000 because that's on the average. I'm not saying that every bank is different. There's different ways to underwrite a file. But, for instance, I have a client in New York. He's a $100 million a year client. I gave him $9 million in a cash advance. He owns resorts, he owns, camps, he owns a whole bunch of different stuff, but he'd rather use me and buy me out early in a 60-day and I give him a 115 early buyout, which is 15%, and it's a 60-day deal, 15%. Nobody else is going to do that for him.
But he's a guy who quite honestly doesn't need that MCA product.
Right.
That's a product of ease for him.
Right.
He's got how much in his coffers? Like this is because he doesn't want to go into his bank account.
So he always needs that extra cash flow until a property moves, or if he sells a property or does something. So what I'm saying is, the guys that come to us like that are doing $100 million. There's an avenue or a need for our product besides an SBA that he doesn't even want to touch because he's like, John, why would I want to do that? And you have to show all my tax returns. It have to be a global debt service coverage ratio because I own 18 companies. And then, how much paperwork is that? How much time is that going to consume to get a deal done for him to be in it for 60 days and then get out of the loan?
But then again, bridge lenders, there's all kind of other lenders. Let's not pretend like there's only commercial banking and then other stuff. There's plenty of tools out there that can be utilized.
MCAs are predicated on SBA and MCA and talk about bridge loans and ABL lenders and stuff like that. So I'm just saying, just based on that, is there ABL lenders? Is there bridge loans? Yes, of course there are. I totally agree with you.
Let me be clear. The market that I see this as predatory on is not the guy who has $100 million in real estate. It's the mom and pop businesses out there that are being shut down like crazy because they don't have the cash flow to be able to pay these back. They get $100,000 and the payback is $150,000, and those kind of companies are being put out of business daily by these types of loans because it's the situation I was talking about before. They don't understand what they're signing on for. They don't understand their own cash flow. So these kind of loans are taking advantage of people like that they don't understand, like, can I even pay back $150,000 on this $100,000 over 6 months or 12 months? They just don't have huge margin businesses like that. So that's where they start getting stacked, and that's where it goes down the drain.
And I agree with you, depending on the industries, right? You're talking about grocery stores that their net margins are maybe 5 to 8%,
right?
And they're going to take,
that's
$50,000 in
payback
not a good
on
a short term to disrupt the work.
Yeah,
sure, I agree.
And for our world, we're talking about SMB, right? We're talking about small business, small market businesses right now.
Hey guys, I want to go back to Joe with something. Joe, you're seeing these businesses put out daily, or like you said, but who's to blame? Because you say they don't understand it, but these are business owners, they're adults. Is it not their responsibility to read what they're signing?
It is their responsibility. Have you ever looked at the contracts? If you don't understand this is not a normal loan agreement. Like it doesn't make sense.
It's a sale agreement.
It doesn't make sense to most people. They don't understand. I'm not somebody who says make excuses for people, right? But when you've got people on the phone that are quoting them BS rates for something that is just not realistic, and tell them, how many people have I saved that the guy's on the phone with them and he tells them, oh, don't worry about it. This will get you started. I'll put a second one on top right after we get this one closed. I just got to get the first one closed before I can do the second one. So you've got a lot of car salesman type people in the industry that are these gentlemen clearly understand the product. They clearly understand how they should be talking about it to people. There are so many people out there selling mischievous products like this and loading them up with debt, knowing that in the very short term, they're not going to be able to handle it. And they're quoting it inappropriately. The business owner does have a responsibility, but I deal with distressed businesses all the time. They're worried about tomorrow, not what's going to happen 3 months or months down the road. And it's just the reality. It's preying on people that are in a position that they don't know what their next step is. And somebody says, I'm going to pay your payroll tomorrow. We'll worry about that next loan right down the road.
Right. And Joe and Jerry, excuse me, I think you'll probably agree with me. Yes, there's a lot of bad actors in our space because it's unregulated. Just like the mortgage industry, because I was there, it was unregulated too when they were doing all these, no document loans, and they came in, they did it one fell swoop, made everybody get licensed. And I've been doing, like I said, 17 years. I'm praying for them to come in and wipe some people out, because like you did say, there are guys out there that just don't explain it the right way. Because yes, they want to make their 10 points. Some funders offer 15 points, right? So I get where you guys are coming from, right? But I also feel the need for the small business owner, like my local pizza shop guy, he only has one oven. If it breaks today, how is he going to be in business unless he doesn't get the money to it tomorrow to get that piece of equipment to get back into his business? Otherwise, he's shut down until he actually can get approved. And most guys in pizza places are cash businesses. You don't really show a lot. His credit's probably not the best. How is he supposed to get approved from the SBA in a short period of time to get his business back up and running to feed his family?
It doesn't even have to be SBA, by the way. There's a lot of other tools.
But let's face it. I'll jump in with the SBA real quick with the bolt loan and with some of these lenders. With some of these lenders out there, they can get you a bolt loan in just as much time, if not less, than it does to get MCA advanced. I mean, right now, I can give you.
I've done a lot of SBA bolts with Bayview. When they first came out, I think the first month I funded $5 million that first month because I had a clientele list of nobody that was showing returns, but their credit scores were 700. So yes, I moved them right out of the cash advances, got them $150,000, and then in 90 days I went back and got another $150 because your cap at the time was 30%. I hadn't done much with them lately. I don't know if that's still the case with the bolt loan, that you can get up to 30%, and then every 90 days until you hit that max of 30%, you can keep getting 150.
So let me ask you a question, Mr. Kroge, because that's a good point. We do the bolt loans too. I think those are somewhat abused as well.
I will agree. I'm up here in Michigan, as Joe's also up here in Michigan. I've known Joe forever. There's a very large bank up here that likes to abuse the bolt loan. I won't say him by name because I get in trouble by it all the time.
I'm in South Florida. We got the same thing going on where they'll come every 90 days or 6 months and give you another one. So they're stacking themselves.
But here's the thing with that, though, Jerry, and it's what John alluded to earlier. They are regulated, and the day of reckoning is coming. I won't go into proper names, but there were a couple really large banks prior to 2008 that were doing something similar to bolt loans. They were SBA express loans. And if you've been around in the market long enough, they were the top 2-3 SBA lenders in the country because they were just banging these out like candy,
I know who you're talking about.
You know exactly who I'm talking about.
Do.
And after 2010, they disappeared. They went away because the regulatory, the SBA came in and said, you can't do this. You lost. You were treating this like a credit card portfolio, and you lost half of it, if not more. And they gave him a cease and desist and cut him off right at the knees. Now, the day of reckoning is going to come again, I hope, I pray, because we are a regulated entity and we are a regulated loan product, that they'll come again and do the same thing to some of these lenders that are abusing the system.
I agree with you. I think they just instituted an additional 2% fee on top too, right? Up front.
They did. So back. You're right. When they had the
when they had not so cheap anymore.
That's right. And then you can't just hide it in their depository documentation. When a business comes in with a pulse and articles of a corporation that says, here, open up a business checking account, and they get their documents back. Oh, by the way, here's a $25,000 SBA bolt loan for you. We automatically approved. It costs you nothing. That's going to change when they see that 2% fee on there. They're not going to accept it anymore.
Right, and that changes the game on those types of programs too.
Right, John, you actually, it sounded like you were calling for regulation in the space. What are you proposing? Are you proposing caps on fees? Are you on commissions, on rates, or what are you thinking?
Yeah, so I propose, in our space, there should be a cap on commissions, right? And listen, I'm a broker, so I get paid by commissions. But I think that, it's the extra fees too that other people charge in this space. So besides that, everybody else, you're getting that back end side of it. Some of them also charging up front, and there should be a cap on that, just like there is in mortgages, right? If you get your yield spread and then you charge up front too, there should be a max between the front and back end like a mortgage. So I'm hoping that we could do that, because there are guys out there that take advantage of people they don't know, like, like Joe was alluding to. There are guys out there that do that, and it gives a guy like me a bad name who's been in the space for 17 years.
Right.
And these new kids come in 18, 19 years old, and they're just flying
Right.
and bagging, like it's the the 80s and 90s of Wall Street, and and it ruins it for a guy like me that really cares about his clients. A lot of my business is referral business now. So, and I'm glad that they come to me. And I'm from, probably a large portion of Long Island in New York, just because everybody knows who I am and how long I've been, and I'm a fair guy. I'm not going to whack you out 10 points knowing that I'm getting paid by the bank. I just can't do it. It's just not in my bones to do that.
See, I'm like you, John. I like to yell at people to get off my lawn as well. I can't stand some of these younger BDOs coming into the SBA space, and they're barely out of college. They're shaking things up, and they've got a sharp tongue, and they're giving guys like us a bad name because they're structuring deals incorrectly. It's getting into underwriting, getting all messed up. Next thing you know, 3 months later, they're coming back to me wondering why their deal is all messed up, and I got to start over with them again. I get it. I agree with you. Like any industry, like in lending or advancement, you're going to get these bad eggs. And I think right now, because MCA got so popular over the last 5 years, especially with COVID, it was the easiest way to get an advance on top of your PPP, your EIDL. That was the next best thing to keep your business afloat. And people are abusing it. You've got a lot of brokers, I'll just say brokers or lenders coming into the market, abusing the system. Like Joe said, here's your MCA, it's approved. Just sign it. I'll get you another one right afterwards. Here you go. You're done. Here's another one. Oh, one more. Here's another one. Here's another one. Using the same bank statements. No one knows what the next person's doing. Next thing you know, you're advanced 4 or 5 times on something that should have been advanced once, maybe twice. And that's what I'm seeing out there, the abuse that I'm talking about. And then it lands on my desk, a hot mess. And I got to look at it and say, man, I feel bad for you that your business is about to go under. But at this point, there's nothing I can do for you. Where if more businesses were reactive, well, more lenders were proactive as opposed to reactive, it could have been held off at the past.
Yeah, I mean, and just to touch on some other stuff, with SBA, and what I find too is like, you gather all the documents, you put everything together, right? You get you put it in, you pray that you pass the E-Trans score, to get into there. But then everything goes through, you close to it, boom, something pops up. The guy had, some type of arrest 20 years ago, or they had a fine from 15 years ago. They can't even find, what the fine was. They got to get a receipt that it was paid, 20 years ago. He got, maybe got a ticket for driving or something, whatever the case may be. And then it kills the deal literally after a 45-day underwrite. These guys get fed up with the SBA, and that sort of brings them in droves to me, because, a lot of guys try it. They're like, John, we tried it. And once again, like you said, Crow, they might have had a younger guy that was just a real aggressive SBA. Don't worry, I'll get you approved. I know how to do this. I know how to do that. And then they don't ask them the right questions, which I feel that, you and Joe is more seasoned, that they would try to find maybe that information out ahead of time, so it doesn't go 45 days. And when they do a final check, on a final underwrite, oh, wait, this just popped up. 20 years ago, you got arrested for XYZ. What was that? Because I've had that issue with the SBAs.
I think the most,
that's why they come to me a lot to go alternative.
I think the most interesting one I had was about 10 years ago. I had a deal stop up just before closing because he forgot.
With Grandpa Kroge.
Story time with Grandpa Kroge. Yeah, because it got caught up because he forgot that at 17 years old in 1963, he was arrested in a city called Centerline here in Detroit for drag racing. And he didn't think it was an arrest because they just took him to jail and made his dad come and pick him up, and it said, no, he could spend the night there and pick him up in the morning. And so he forgot. He's like, I didn't think about that, but it held up the whole entire application through closing. So I get that, John. I get that.
Yeah.
Did you close it?
We did close it. We did close the loan. We closed the loan. We got it cleared. Had to write up a whole memo as to why it happened, what happened, this, that, and the other. But we did get it closed. We did get that cleared.
Guys, I would like to give Jerry and Joe some final words, since you guys did some opening remarks, and then, I'm going to wrap it up here. So, Jerry, why don't you start closing us home here?
I think that there's a place for all these types of loans or advances that we're talking about. I do want to say that something that keeps getting brought up is that the MCA space exploded in the last 5 years. Yes, it was primarily due to COVID, but if you go a step back further, in 2008, when the financial crisis hit, all the mortgage brokers were flushed out. They got into this space, and this space went like this. Okay. The banks froze up. Private lenders were the only game in town. And I believe, forget about COVID, that's when this space really blew up. There are tons of new businesses opening every single day. And maybe you have some SBA programs where you can help them. My knowledge is, you've got to wait a little bit of time before you can get an SBA loan. So there is a place at the MCA. I will say there are tons of major companies getting involved, such as Shopify, in unsecured lending. Now, you guys say 40, 50% a year is predatory lending. Shopify does it. They'll give you a 10 or 12% loan, but it's paid back in 90 days. So if that person keeps re-upping, think about it. They're paying 40, 50%. So we get those files all the time. Oh, I got a Shopify loan. I paid 10, 12%. But you're paying it back in 90 days. And if you re-up it, you're doing 48% a year. Thing. So, I mean, Shopify is a very big, well-known company. I'm just saying that everyone has gotten in the game for unsecured financing because it's quick, it's accessible, it's fast, and it's convenient.
And it's super profitable for them.
Right,
100%. Hey, this isn't a charity, Joe.
Shopify funded $9 billion last year.
Correct.
$9 billion.
Correct.
Yeah, but so...
Joe, final words?
Okay, look, I want to start this off by saying just because there's other bad actors, it doesn't justify the product in the marketplace. Like, just because one guy's doing it and it's wrong, doesn't mean that everybody else can jump in the pond and do it and justify the product. Look, I have not seen a case where an MCA actually successfully brought the company or the borrower to where they needed to be. There's a lot of issues with the product in that it's being sold inappropriately. It chokes all the cash flow out of the business to the point where the borrower doesn't have a choice but to take more of it on. I've talked to multiple commercial lenders, SBA or otherwise, that have it. They say if they see an MCA loan, it's basically a non-starter for them to look at because it creates character concerns. What is the first thing that a lender looks at? Character, then cash flow, then collateral. So you're already hurting their takeout opportunities because you've taken on these loans, 1, 2, 3, whatever it may be. Regulation is absolutely needed in this industry. I'm glad to hear you guys both support that because I've never seen an industry that needed regulation more than this industry because of the way it's being taken advantage of. But the reality is, look, if these were reasonable funding tools, I'd really like to know why the paybacks have to be so exorbitant for the borrower or seller, I guess I will call them. I want to know why it's so profitable for the companies that are letting the money out. Why is it so profitable for the people that are brokering it? And why is that all being left on the borrower, who's typically going to be in a situation that they're challenged? It's not all actors are bad, but there's a lot of bad actors in this industry.
Well, my takeaways are, yes, there's bad actors in both industries, all industries. There's a lot of misinformation in both sides. Like just even here today, we both were able to squash some myths on both sides. And just more education and more information about what people are getting into is only going to help. So I think that was a great discussion.
Right, I'm going to actually jump in on a final. I just want to just say something to what Joe said on a couple things.
Okay, fine. You can respond to it.
I apologize. I
was rapping, but it's okay.
Why is it costful, right? So first of all, on alternative financing, when you got to borrow the money, they're giving us the money at 15 to 18% because it's high risk, right? Because there's no personal guarantees. It's all performance guarantees. Unlike the SBA loans or other loans, there's an asset there, there's personal guarantees. So it is a high risk industry. So our money costs twice as much to lend it out. That's why it costs so much money to put the money out.
Okay. Risk-based pricing, we understand. Well, fellas, thank you so much for that. Very, robust
can I
and
say
polite.
Something?
No, are you joking? You're joking, right?
No, I just want to thank you for having us on, Ray. That's all.
Okay.
Appreciate
yeah.
the time,
Let's do
Ray.
it again sometime. All right. Well, that's it. Signing off. Until next time. Ta-ta.
Thanks, guys.
All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and The BDO Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of The Art of SBA Lending. Ta-ta.